Welcome back. Our latest installment of our Substack newsletter. If the jobs numbers are so good, why does the labor market feel so bad? We're going to take a deep dive into the five key economic reports and get a better understanding of why there seems to be such a divergence between the rosy economic numbers that speak to the labor markets and the reality on the ground. We start off with non-farm payrolls. It's a monthly report that measures the number of jobs added in the non-farm sector, as well as the unemployment rate, the percentage of the total labor force that is unemployed but still seeking employment, reported by the Bureau of Labor Statistics. Now, if you recall, just last week we had a non-farm payroll report. It was quite rosy. 353,000 new jobs created, revising last month's 216 up to 333,000 jobs. It was really good news. So we thought. We take a look at this on a year-over-year basis, though, and it's a different story. That 353,000 jobs number is actually down 27% comparing this January to last. You see, the labor market is a very seasonal market. We tend to see slowdowns in December and a ramp up in hiring in January. So it wouldn't be fair to compare December to January. It would be more fair to compare January to last January, which in this case is down 27%. The unemployment rate was reported to have remained flat at 3.7%. That's not bad, staying at those low levels. However, on a year-over-year basis, that 3.7% is actually an 8.8% increase from January of last year. Unemployment rate going up is certainly not a good sign. The ADP National Employment Report measures a change in U.S. private employment and pay from payroll data. It's reported by the ADP Research Institute. ADP total non-farm private payroll on a year-over-year basis. It was at 5.7%. That was March of 22. Currently only up 1.9% on a year-over-year basis. By the way, today's video is merely a summary. If you'd like to read the full report, we're going to post a link to the Substack newsletter. It's absolutely free in the comments of this video. Now, the ADP report represents a significant decline over the past number of years. The ADP report measures private payroll. Now, on a year-over-year basis, we can see how the different subsectors within the ADP report managed. In particular, we see the most amount of growth in natural resources and mining, construction, education and health services, leisure, hospitality. We also see within the ADP report, it breaks down the companies by their size. In particular, we can see the white line. Those are companies with 50 to 249 employees. That has declined over time. The companies with 500 or more employees, the yellow line, that has declined also. In fact, every single line has declined, 250 to 499, except for the blue line, that has risen. But those are very small businesses with only 1 to 19 employees. So overall, ADP payroll has shrunken except for those very small businesses. The JOLTS Job Openings and Labor Turnover Survey is a monthly report that counts the job openings. It can be considered a leading indicator as a job posting today may translate into a job next month or maybe several months from now. Now, the JOLTS non-farm report on a year-over-year basis shows a 20% decline from December of last year. In fact, this is the second worst number in quite a long time, only surpassed by July of 23. Now, the JOLTS data can be divided into several subsectors as well. And we can see here each line represents those different subsectors. In particular, we see massive declines in leisure and hospitality and accommodation and food services, which is actually kind of troubling. They're considered to be discretionary spending, and when the economy falls into trouble, usually we see the discretionary spending, those declines really kind of stand out, which is really what we're looking at now. Now, the JOLTS data on a year-over-year basis shows a significant declines. In particular, we can compare the ADP, the payroll on the left-hand side, to the JOLTS data on the right-hand side. Again, left-hand side shows us current payrolls, right-hand side shows us job openings, potential future jobs. In particular, notice how the data really does reveal what's going on here. In particular, left-hand side, ADP, current payrolls, experiencing a 5.5% increase in those payrolls in leisure and hospitality. However, on the right-hand side, the JOLTS, the job openings, a 46% decline in job openings. So while the payrolls have gone up modestly, their future job openings has declined quite a bit. Same holds true for construction. 4.8% increase in payrolls, but job openings for future jobs down 8%. Trade, transportation, utilities, 1.1% increase in payroll, 25% decline in terms of new job openings. In terms of job openings, we also can talk about the Indeed job postings data. This is, sourced from the Indeed global job postings website. It calculates the change in job postings since their baseline of February 2020 when the index began at 100. Indications above 100 indicate growth, below indicate decline. Now, in particular, we can see that number was 164 as of January of 22. It now stands at 137, a significant decline in the number of job postings on the Indeed websites. We can see every line here represents a different state, and there certainly is a divergence. The states with the greatest amount of job postings include Alaska, South Dakota, North Dakota, and Montana. The states at the bottom of the list: New Jersey, California, Washington, and New York. New Jersey, California, Washington, New York. And we also see, in terms of the industries, there's a pretty wide divergence as well. Notice, by the way, and this takes place for the industries as well as the state data. On the left-hand side of the chart, we see these lines are very contracted towards one another. But on the right-hand side, there's more of a divergence. It means there's more of a segmentation, so to speak, within the labor market. They're being affected by different forces. In a strong economy, all states, all industries tend to perform better. Now, here's a very interesting chart. It shows us the different reports that we spoke about: ADP, non-farm payroll, JOLTS, Indeed, and unemployment. And notice how the lines have behaved over the past couple years. In particular, the blue line, that's the unemployment rate that has risen year over year basis. The non-farm payroll and ADP, they haven't not moved very much. Those are not as volatile, in all due fairness. However, the yellow line, the JOLTS, and the purple line, the Indeed, those represent job postings, potential future employment. Those are the weakest lines that we see. What can we infer from this? That perhaps because the job postings represents the worst numbers of all the numbers we've seen, the future outlook for the labor market does not seem so rosy. As we said before, this is just merely a brief summary. Our full long-form analysis can be found on our Substack newsletter, substack.com, absolutely free to join. And please just enter our data, just the data here, just _the_data. We hope this has been helpful. We look forward to seeing you back soon.